Welcome back, you insanely curious learner. Today we are decoding some pretty massive multi-billion-dollar moves from the legendary value investor Seth Klarman.
Right. And trying to figure out why one of the greatest, traditional bargain hunters in finance is suddenly backing up the truck for big tech.
Exactly.
Yeah.
But before we get into the weeds on that, I have a quick bit of mandatory housekeeping to cover directly with you.
Go for it.
To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai and research.deepvalues.ai.
Definitely worth checking out.
Yeah. And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Highly recommend that one.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Always essential to keep in mind.
Okay, let's unpack this. Our mission today is to look at the raw data from the newly released Q4 2025 Form 13F from Seth Klarman and her hedge fund, the Baupost Group.
It is, it's just an incredible data set to dig into. We are looking at their SEC filing, detailing exactly what they held as of December 31st, 2025.
Right.
And this document gives us a very clear, completely unvarnished window into a highly concentrated $5.28 billion portfolio.
$5.28 billion, that's a huge footprint.
It is. But more importantly, it challenges everything we think we know about this sector. I mean, value investing has this lingering stereotype attached to it.
Oh, for sure. People think it just means buying cheap, dying companies.
Exactly. The classic cigar butts with, one last free puff left in them. But Klarman's current portfolio is a violent rejection of that idea.
Violent rejection. I like that.
He is showing us that modern value investing is strictly about finding asymmetric risk and reward.
Yes.
And right now, he is finding that required margin of safety in some incredibly surprising, highly digital places.
That's the part that really stands out to me. We are seeing this massive strategic shift from physical infrastructure into digital platforms.
Completely.
And I really want to explore exactly what that means for your own understanding of value investing, whether you are managing a massive fund or just your own retirement account.
It applies to everyone.
Exactly. But let's start with the 30,000-foot view. The headline numbers for Baupost are intense.
Very.
Their reported 13F assets surged 11% from Q3, reaching that $5.28 billion mark. But the really wild part isn't the total number.
Right. It's how tightly it's packed together.
Yes, that massive amount of capital is spread across just 22 total holdings.
If we connect this to the bigger picture, that level of extreme concentration is the absolute hallmark of high-conviction investing.
It takes guts.
It takes a lot of guts. Klarman is operating as a true value realizer.
Right.
He is not just spreading his chips evenly across the roulette table to safely match the returns of the S&P 500.
No, he's actively making bets.
He is confidently allocating nearly half of his entire capital base to just his 5 absolute best ideas.
Just 5. When you break down those top 5 positions, it paints a very specific picture.
It really does.
You have Restaurant Brands International, Amazon, Willis Towers Watson, Elevance Health, and Union Pacific.
Quite the mix.
Together, those 5 companies make up a whopping 43.73% of his entire portfolio.
Incredible.
I mean, just pause and think about that in the context of your own portfolio. Imagine having nearly half your net worth tied up in just 5 ideas.
Right. It requires an immense amount of foundational research.
Exactly. But it also requires absolute conviction that you are right.
Conviction, yes, but also a very clear, uncompromising narrative of where the global economy is going.
Yeah, you have to have a thesis.
And the distinct rotation we saw in this fourth quarter filing is a deliberate move out of traditional physical world winners.
The old reliable stuff.
Right. Klarman is actively harvesting profits from companies that build things out of concrete and steel, and he is making an aggressive leap into wide-moat, highly cash-generative technology companies.
That's just such a pivot.
It is. He seems to be recognizing that the most unassailable, bulletproof economic moats today aren't necessarily physical infrastructure anymore.
They're digital.
Yes. They're made of code, closed ecosystems, and massive digital switching costs.
Here's where it gets really interesting, and honestly, where this SEC filing totally surprised me.
The Amazon bet.
Yes. Seth Klarman initiated a massive, brand new $489.7 million position in Amazon.
Huge.
He bought over 2.1 million shares in a single quarter.
In 1 quarter.
Right. It wasn't a toe in the water, it was a cannonball.
A nearly $500 million cannonball.
It instantly became the fund's second largest holding, sitting at 9.28% of the entire portfolio.
Yeah.
But I have to push back here. Why does a traditional value investor buy Amazon in late 2025? It's hardly a hidden secret trading at a deep discount.
Well, it's a phenomenal move, precisely because it challenges that old school thinking. To understand the why, you have to break down Amazon's economic moat.
Which is massive.
Right, it's multi-layered and incredibly wide. First, yes, you have the network effects of its core e-commerce marketplace.
Buyers go there because sellers are there.
And sellers go there because the buyers are there. Then, you have the insurmountable cost advantages built into its massive logistical scale.
Nobody can catch up to their delivery network.
Nobody. But the true crown jewel, the real reason a value investor gets interested, is where the highest switching costs reside.
AWS.
Amazon Web Services, and the broader Prime ecosystem.
Right, because switching costs are essentially the financial penalty a customer pays to leave your business.
Exactly.
And with AWS, that penalty is enormous.
Once an enterprise-level company builds its core digital infrastructure on AWS, once its data, its applications, its security protocols are all intertwined with Amazon's servers leaving, becomes a logistical nightmare.
You just can't unplug it.
It's incredibly painful, incredibly risky, and extremely expensive to migrate to a competitor. That stickiness guarantees future cash flow.
And the financial fundamentals driving this specific value play are frankly off the charts right now.
Unbelievable numbers.
AWS isn't just resting on its laurels. They are aggressively integrating generative AI and large language models into their cloud offerings.
Which is driving massive growth.
That integration alone drove a massive 48% revenue growth in their cloud-related segments in Q4.
48% for a company that size.
Right. You look at the raw cash generation, their operating cash flow jumped 36.8% year over year.
I love that.
To $35.53 billion.
Wow.
Plus, they are sitting on an absolute fortress of a balance sheet with $66.9 billion in cash and zero short-term debt.
That right there is the definition of a foundational cash cow.
Totally.
When you have that much free cash flow flooding in, combined with a fortress balance sheet, you possess the ultimate margin of safety.
Because they can weather anything.
A company like that can weather virtually any macroeconomic storm, whether it's inflation or a recession.
Yeah.
Even more importantly, in 2025, they can self-fund their own massive capital expenditures into the next technological frontier, like advanced AI infrastructure.
Without needing a loan.
Exactly, without needing to go to the banks and borrow money at today's higher interest rates.
But it still totally challenges the traditional notion of what a value stock looks like.
It does.
When a legendary value investor buys a quote-unquote tech stock that's trading at 21 times forward earnings, it forces you to rethink the rulebook.
It really breaks the mold.
A lot of traditionalists would look at a 21x multiple and say it's just too expensive.
Sure.
But Klarman is looking at that multiple, weighing it against the predictability of that $35 billion in operating cash flow and saying, given the cash flow growth, this is actually cheap.
He's looking at the future.
And the broader market analysts seem to agree with his thesis. They're modeling a median price target of $295.05, which implies a 20% upside from where the stock ended the year.
It's a perfect textbook example of how modern value investing isn't strictly about hunting for low price-to-earnings ratios anymore.
Right.
It's about paying a price today that represents a significant discount to the actual cash way the business will reliably generate 10 or 20 years in the future.
Cash is king.
Klarman clearly believes that the broader market is still fundamentally underpricing the long-term cash generation capabilities of an AI-powered AWS.
Which brings us to the most dramatic narrative that unfolded in these Q4 filings. I'm calling it the Battle of the Oracles.
Oh, this is the best part.
Because while Seth Klarman was busy piling nearly $500 million into Amazon, Warren Buffett's Berkshire Hathaway was doing the exact opposite in the exact same quarter.
What's fascinating here is how two absolute legends of value investing, two guys who read from the exact same fundamental playbook, are viewing the margin of safety entirely differently right now on the exact same company.
It's an incredible divergence. The 13F filings revealed that Buffett slashed his Amazon stake by an unbelievable 77%.
77%.
He dropped his holding from 10 million shares down to just 2.27 million shares.
A massive exit.
So you have Klarman literally backing the truck up to load Amazon shares into his portfolio, while Buffett is aggressively driving his truck away to unload them. How do you even reconcile that?
It perfectly illustrates that high-level investing is not a hard, predictable science.
It's not just math.
No, it's an art informed by personal philosophy and risk tolerance. Buffett is likely looking at his Amazon position, realizing he has already captured significant multi-year gains and deciding to rotate out.
He made his money.
Exactly. In his view, the margin of safety might have eroded as the price climbed. He might also feel that the rapid integration of AI pushes the tech landscape outside of his famous circle of competence.
That makes sense for Buffett.
But Klarman, on the other hand, is rotating in. He is making a calculated bet that the broader market, and perhaps even Buffett himself, still fundamentally underestimates how much of a foundational, utility-like cash cow AWS has become in an AI-driven economy.
Wow.
Klarman sees AWS as the new digital railroad.
This raises an important question for you, the listener, regarding your own investment strategy. When do you actually take profits?
The hardest question.
It is notoriously one of the hardest things to do in investing. You buy a stock, it goes up, and human nature tells you to hold on forever because it might go higher.
Greed kicks in.
But Klarman gave us a masterclass in disciplined profit-taking this quarter. And he didn't just do it with his new buys. Look at his moves with Alphabet, Google's parent company.
Absolutely. Klarman actually slashed his Google stake by 41.5% in Q4.
Right.
And remember, that was after he had already started trimming it in Q3.
So it was a sustained exit.
Yes. The reasoning behind it is just textbook investing discipline. Between May of 2025 and the end of the year, Alphabet's stock essentially doubled in price.
Massive run-up.
It hit a valuation of 23 times forward earnings. He clearly hit his internal intrinsic value target.
He did the math.
As the price rose so dramatically, the mathematical margin of safety shrank. He didn't get greedy. He confidently took his chips off the table.
And he didn't stop with Google. We are seeing what I call the great infrastructure harvest.
A great way to put it.
He brutally cut his stake in the building materials giant CRH plc by a massive 68.3%.
Huge cut.
He also trimmed his Dollar General position by 22.7%.
That CRH sale is particularly illuminating if you want to understand how a value fund operates.
How so?
In previous quarters, Klarman actively championed CRH. He was vocal about loving their move to a U.S. listing and their massive, almost unassailable infrastructure moat in building materials.
Right, he talked them up.
But when you cut a position of that size by over 68%, it sends a very clear, unemotional signal. The anticipated re-rating he was waiting for finally happened.
Right, a re-rating meaning the broader market finally woke up, recognized the underlying value that Klarman saw months ago, and bid the stock price up to match its true multiple.
Precisely. The stock price caught up to his calculation of its intrinsic value.
So he's out.
And this is the key lesson. He doesn't fall in love with his stocks. He falls in love with the margin of safety.
That's a great quote.
When that margin of safety is gone because the price has gone up, his job is done, and he moves on to find the next mispriced asset.
So where is all that harvested cash going? We know nearly $500 million went to Amazon, but what about the rest?
Good question.
Well, the filings show he initiated a brand new $108.5 million position in Molina Healthcare, which makes it just over 2% of the Baupost portfolio.
Okay.
He also initiated a new 2.02% stake in Grupo Aeromexico.
That Molina Healthcare purchase is a very strategic addition that fits perfectly into Baupost's broader, long-standing healthcare thesis.
They've always liked healthcare.
Managed care is an industry with incredibly strong, predictable demographic tailwinds, namely an aging population.
Yep.
And complex regulatory environments. Those regulations often create high barriers to entry, which keep new competitors out.
Keeps the moat intact.
Interestingly, while he was buying Molina, he did slightly trim his massive Elevance Health position by 3.8%. But despite that small trim, it's clear he still deeply loves the managed care sector as a whole.
So what does this all mean for the rest of the portfolio? We've talked extensively about the big tech buys and the infrastructure profit harvesting, but let's run through Klarman's steadfast anchors.
The foundational pieces.
These are the positions he is holding on to tightly. Let's start with his absolute #1 position.
Fair.
Restaurant Brands International, ticker QSR. It's sitting at 10.44% of his entire portfolio.
This is a really interesting anchor to unpack because it possesses a very un-Buffett trait.
Yeah, totally.
Restaurant Brands International, which is the parent company of Burger King and Tim Hortons, has high leverage.
A lot of debt.
If you look at their balance sheet, we are looking at a net debt to EBITDA ratio of over 6.0x.
That's steep.
Now, in a world where interest rates are no longer sitting at zero, that kind of heavy debt load usually sends traditional value investors running for the hills.
They hate debt.
Because the fear is that the cost of servicing that debt will eat up all the free cash flow.
Right. But Klarman is holding strong. He only trimmed it by a tiny 2% in Q4. It seems like a contradiction.
On the surface, yes.
Why take on that debt risk? Well, he's clearly betting heavily on the execution of their 5-year growth plan stretching out to 2028.
He trusts the plan.
He understands that their business model is an asset-light franchise model. The franchisees take on the risk of running the actual stores, while corporate just collects the royalties.
It's a great model.
He believes that brand power will generate more than enough predictable cash to manage that debt pile and still deliver huge returns to shareholders.
It is a stark contrast, though, when you compare the leveraged balance sheet of QSR to the pristine, rock-solid fundamentals of his other major anchors, specifically Elevance Health and Union Pacific.
Let's talk about Elevance Health, ticker ELV. Even after that slight trim, it's still his fourth largest holding.
Elevance is your classic, textbook wide moat business. They have massive, almost unfathomable scale with 117 million members.
117 million.
And they possess the ultimate regulatory moat Blue Cross Blue Shield licenses.
You can't just copy that.
Yeah. You cannot just raise $1 billion, start a new health insurance company tomorrow, and replicate that network. It's impossible.
Right.
From a financial health perspective, they boast a remarkably consistent 13.3% return on equity. But here is the real value proposition that Klarman is seeing.
Okay.
Despite all that quality, it is trading at a deeply undervalued 13.8 times price-to-earnings ratio.
That is cheap.
If you run the numbers, some discounted cash flow models actually suggest the stock is over 70% undervalued, giving it a target intrinsic value of $588.80.
Wow.
When you buy a high-quality, wide-moat business at that kind of discount, that is a massive margin of safety.
And then there is Union Pacific, ticker UNP, sitting at over 7% of the portfolio. If Elevance is a regulatory moat, Union Pacific is the ultimate physical moat.
Exactly.
This is the textbook natural duopoly. They control a 30,000-mile railroad network across the western United States.
30,000 miles.
Talk about an impossible-to-replicate asset. You literally cannot buy the land, get the environmental permits, and lay 30,000 miles of steel track today to compete with them. The barriers to entry are infinite.
Exactly. And the underlying financials perfectly reflect that geographic dominance.
Yeah.
Because they don't have to compete on price with a dozen other railroads. They have an incredible 40.9% operating margin and an exceptional 40.4% return on equity.
Just printing money.
What's particularly notable in this Q4 filing isn't just that Klarman held the stock. He actually added 8.8% to his Union Pacific stake.
Added to a winner.
He clearly loves how the management team is allocating capital right now, particularly their recent $1.2 billion locomotive modernization deal.
Reinvesting in the business.
That is a prime example of a management team actively spending their cash to maintain, defend, and even widen their economic moat through long-term fuel efficiency and reliability.
It's such a brilliant, balanced mix of assets. You have the asset-light royalty model of QSR, the regulatory mode of Elevance, and the physical monopoly of Union Pacific.
Very balanced.
But we have one last explosive move to cover from this filing. Klarman more than doubled his stake in Fiserv, ticker FISV.
That was a shocker.
He increased his position by a staggering 145.8% in a single quarter.
Fiserv is a beautiful, real-world example of opportunistic value investing.
Explain that for us.
For those who aren't familiar, Fiserv is essentially the central nervous system for bank processing. When you swipe a debit card, their software is what talks to the bank to verify the funds.
Okay.
Because their software is so deeply, fundamentally integrated into a bank's daily operations, the customer switching costs are extreme.
And so that penalty again.
Think about it. A regional bank is not going to easily rip out its core processing software, risking an outage that would make front-page news and infuriate customers just to save a few pennies on a cheaper software contract.
The risk is too high.
It's simply too risky. This dynamic gives Fiserv incredible long-term pricing power, which is directly reflected in their very strong 28.7% operating margin.
So why did he choose right now to double down so aggressively? The catalyst was a temporary market overreaction.
The markets love to overreact.
Late in the year, the stock dropped 5% because the company issued slightly weaker than expected guidance for 2026.
Right.
Klarman looked entirely past that short-term noise. He saw that the wide moat was completely intact, and he pounced.
He took advantage.
He snatched up those dropped shares at a massive 14% cash flow yield. It's the ultimate form of high-conviction bargain hunting.
It perfectly highlights the fundamental difference between a trader and an investor.
Yes.
The trader sees a 5% drop on bad quarterly guidance, worries about the momentum, and panics.
They sell.
An investor like Klarman sees a resilient, wide-moat, cash-generating business temporarily going on sale, and he aggressively buys the dip.
What an absolute journey this Q4 filing has been to unpack.
A real masterclass.
To synthesize all this for you, Seth Klarman's Q4 2025 portfolio is this fascinating, evolving hybrid. It blends Buffett-style quality buying, the wide moats of Elevance and Union Pacific, with classic Klarman-style opportunistic value, like pouncing on the Pfizer dip.
Best of both worlds.
But the biggest undeniable takeaway from this entire document is his aggressive move to fund wide moat, cash-generative digital platforms, specifically Amazon, by systematically harvesting his massive gains from the physical world, like his exit from CRH.
And that deliberate transition from the physical to the digital leaves us with a really important, provocative thought to consider.
What's that?
As traditional old-school value investors continue to flee high-flying tech names because they're scared of high multiples, Klarman's massive high-conviction bet on Amazon's AWS and his doubling down on Pfizer forces us to ask a difficult question.
Okay.
In a world that is becoming entirely inescapably reliant on digital architecture and AI integration, will value investing eventually be forced to abandon physical assets altogether?
What?
Will the next generation of value investors have to completely redefine the concept of a margin of safety, purely in terms of digital switching costs and data network effects?
That is definitely something for you to mull over as you look at the composition of your own portfolio this week. Ask yourself, are your moats physical or are they digital? And how hard is it for your customers to leave?
Great questions to ask.
If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated. Thank you so much for joining us on this deep dive. Keep learning, keep questioning, and we will catch you on the next one.